Welcome to the Deep Dive. Today, we're looking at something really interesting, how Warren Buffett handled the recent market shifts. While a lot of people saw their investments dip, his actually went up.
Exactly. And we're basing this on a really great piece from FinShots. It's dated April 9th, 2025. The title is, Warren Buffett Wanted You to Buy This Market Dip. It paints a pretty clear picture of his approach.
Which is why we follow him, right?
Right.
I mean, that track record speaks for itself. So, yeah, our goal today is to really unpack this article. What was Buffett up to? And maybe more importantly, what lessons are in it for you listening?
Yeah, the article kicks off with this pretty stark contrast. In 2025, markets were rocky. Lots of billionaires lost money, but Buffett's Berkshire Hathaway, their value actually increased by about $13 billion.
$13 billion, while others were losing. Okay, that definitely makes you lean in. How did he pull that off?
Well, it wasn't just a 2025 thing. The groundwork, according to the article, was really laid back in 2024. It seems like he was preparing.
Preparing how? What was the move?
It was a big one. In 2024, Berkshire sold off equity stocks worth a massive $134 billion.
Oh, $134 billion. At a time when the market was still pretty hot, right? That takes some guts.
It really does, going against the herd like that. So the big question then is, what did they do with all that cash?
Right. You don't just, stuff $134 billion under the mattress. Hopefully not.
No. The article states pretty clearly that the vast majority went into U.S. Treasury bills, T-bills.
Okay, T-bills, so safe harbor stuff.
Exactly. Maybe not the most exciting investment, but they're safe, predictable, and at the time they were yielding around 5% a year.
5%, which on $134 billion is, let me think. That's serious money just for parking it safely.
It is, and that move built up their cash pile even more. The article really drives home the scale of Berkshire's cash reserves now.
How big are we talking?
Around $330 billion in cash and equivalents, mostly those T-bills.
$330 billion.
Yeah. And to put that in perspective, FinShots points out that's more cash than the entire market value of companies like Starbucks, Ford, X, the New York Times, Target, and Zoom combined.
That's staggering. Just mind-boggling liquidity.
And think about the income. Just earning, say, 5% on $330 billion, that's over $14 billion a year in interest.
Wow. So they're literally getting paid billions just to wait, to be patient.
Pretty much.
Yeah.
Which leads right into his core philosophy, doesn't it? The article digs into why he'd adopt this, seemingly cautious stance.
Yeah, what's the thinking behind it? It's all about value, right?
Absolutely. His whole thing is focusing on valuation. The famous quote, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price."
Right. So he's not chasing trends if the price isn't right.
Exactly. The article mentions he tends to steer clear of, like, the hot private equity deals, maybe overly aggressive stock buybacks when prices are high, definitely crypto, even the AI boom if the valuations felt bubbly. He avoids the hype.
Okay, that makes sense. And the article brought up something called the Buffett indicator. What's that about? How did that play into the 2024 decision, potentially?
Right, the Buffett indicator. It's basically a ratio comparing the total value of the stock market, all traded companies, to the country's GDP, the economic output.
Okay.
And the key point in the article is that this indicator shot past 200% in late 2024. 200%.
Which means the stock market's value was like double the entire economy's output.
Essentially, yes. And Buffett himself has called levels like that playing with fire. It's a strong signal, for him at least, that the market might be seriously overvalued, out of whack with reality.
So a major warning sign flashing red on his dashboard. Were there other signs mentioned?
Yeah, the article also points to the S&P 500's price-to-book ratio. That compares stock prices to the company's net assets, its sort of accounting value.
And that was high, too.
Apparently, it hit levels we hadn't seen since the dot-com bubble back in the late 90s, another sign of potential frothiness in the market.
Okay, so multiple indicators suggesting things were overpriced. That paints a clearer picture of why he might sell $134 billion in stock. But the article also hinted at maybe broader worries, like geopolitics.
It did touch on that. Things like the potential return of Trump to office and the prospect of more tariffs being introduced, that adds a layer of uncertainty to the global economy.
And Buffett's not a fan of tariffs, is he?
No, the article reminds us he's called them economic warfare. And you know his number one rule?
Don't lose money.
Exactly.
Yeah.
So, heightened uncertainty, potential economic disruption. It aligns with a more cautious, capital-preserving approach.
Interesting. And there was another angle, too, right? Something about succession planning.
Yes, that's a fascinating point the article raises. This huge cash pile, the $330 billion, might also be, let's say, a strategic setup for his successor, Greg Abel.
How so?
Well, Berkshire hasn't made a massive acquisition in a while. Buffett's been saying prices are too high. This huge war chest gives Abel enormous firepower to make big landscape-changing deals when or if prices become more attractive.
Ah, I see. So it's positioning the company for the future, under new leadership potentially,
Yeah.
giving him the tools he needs when the time is right.
Precisely. It provides flexibility for the next era of Berkshire.
And looking back, this isn't exactly new territory for Buffett, is it? The article drew some historical parallels.
Definitely. It's kind of his playbook. Remember the dot-com bubble in '99? He famously sat out the tech frenzy, looked almost out of touch for a bit
Because all it burst.
until it burst, exactly. Then 2008, the financial crisis. He wasn't panicking. He was making deals, investing in Goldman Sachs, General Electric on very favorable terms.
Right, when everyone else was running for the hills.
And even during the COVID crash in early 2020, he was relatively cautious, didn't immediately jump in with both feet. He waited. Patience seems to be the common thread.
Patience. And it pays off. The article mentioned Berkshire's long-term performance numbers, which are just incredible.
They really are. From 1965 to 2024, Berkshire Hathaway delivered a compounded annual growth rate, or CAGR, of about 20%
20%.
annually,
For almost 60 years.
compared to the S&P 500, which did about 10% over that same period. Still good, but not 20%.
The difference over time is huge, isn't it?
Oh, yeah. The article used an example, I think it was with Indian rupees, but the idea holds if you invested, say, $100 with Buffett back in '65 versus $100 in the S&P 500, the difference today would be astronomical. We're talking millions versus maybe tens of thousands.
It really hammers home the power of that compounding and his strategy. So, okay, let's bring it back to today. Buffett's sitting on his cash, earning interest, waiting. What's the big takeaway for, regular investors, for you listening?
Well, I think the core principles translate even if you're not dealing in billions. It's really about cultivating patience. It's about doing your homework to understand the real value of something, a stock, maybe a house, maybe even a business idea.
Finding that intrinsic value.
Right. And then, crucially, having some dry powder, some cash set aside. So when you do see an opportunity where something you understand is selling for less than you think it's worth, you can actually act on it.
You don't need to be a billionaire to keep some savings ready for a rainy day or a sunny opportunity.
Exactly. And I liked the analogy the article used. It's better to pay, say, $80 for something you're confident is worth $100 than to pay $100 for something that might be worth $150 someday.
Yeah, that really clarifies the value focus. It applies to so much, not just stocks. Buying a car, negotiating a salary.
For sure. And it's not like he's completely inactive. The article mentioned his recent investments in some big Japanese trading companies. So he is finding value, just maybe not in the places everyone else is looking right now.
He's still hunting, just selectively. So it really makes you think, doesn't it? As we wrap up this deep dive, how are you feeling about the market? Are you thinking about value, about keeping some dry powder, like Buffett?
Yeah, I think the main point from digging into this Finchot's piece isn't that Buffett magically predicted the downturn. It's that he was prepared. He stuck to his long-term principles of value investing, built up cash when things looked expensive, and now he's positioned. It's about discipline, not a crystal ball.
Discipline and patience. So maybe the final thought for you is this. How can you bring a bit more of that discipline, that focus on real value, into your own financial life, whatever the market's doing? What does dry powder mean for your situation? And how could it help you grab opportunities down the road? Something to chew on. Thanks for joining us on the Deep Dive.